After a month of meeting with policymakers, CEOs, and lots of entrepreneurs around the world, I wanted to give you a feedback of where do we stand on duration across the world. In Japan, we see stronger growth, better capital allocation, yen is undervalued, and the forward curve in Japan, in our view, is underappreciating interest rates hike coming next year. Secondly, in China, we've always been historically bearish, but in August we turned more positive given the valuation gap, and the latest stimulus, it's a sign they're trying to fight. So tactically, we're positive on it, even though structurally, the deflation scare that will come out of overinvestment in fixed assets and the real estate bubble will take years to clean. In Europe, ECB was wrong in our view in being very slow. Inflation is falling fast, growth even faster, and as a result, they will need to cut. Remember that only 6 months ago, they refused to admit that they were behind the curve. In our view, they were behind the curve this time again. And hence, on a duration basis in Europe, we're happy to stay a bit longer because growth is falling fast. And the real culprit of it is the fact that the industrial policy that has failed to create growth over the last couple of years is putting under stress the auto car makers and the industrial complex of Germany, which has been the leading engine of European growth. In the US, the opposite is happening. Growth is accelerating. Remember, they are printing $3 trillion or 7% deficit, and as a result, you cannot not grow when you print 7%. They're in a way abusing the reserve currency status, as demonstrated by gold appreciating constantly. But most importantly, both Harris and Trump have only one plan: spend more. And as a result, deficit ain't coming down. That means at the margin, the risk is, in our view, that we have an inflation comeback in 2025 and 26 in the US if they were to materialize the deficit number which they have been promising to voters. Historically, at the first Fed cut, you sell the 10-year. But last year, remember, in November, we went long duration when it was non-consensus, and we're adjusting duration as of last September on the first Fed cut. That's because when you look at the last 5-6 years, the first Fed cuts when you had to rein duration back in, because basically the rates market had already more than fully priced every expectation of cuts. We will attend the IMF meeting, so have more than 50 meetings lined up next week. We'll come back to you if we learn anything on top of this. Thank you.